Hello everyone, welcome to the 184th episode of me learning how to trade in Forex. So in the last episode we went through an introduction to the Greeks. So the Greeks are a measure of individual risks associated with trading options, and they're called Greeks because each one is identified by a Greek letter. So we went through three of them. So delta, which is the ratio that compares the change in the price of an asset to the corresponding change in the price of its option. So delta shows how much an option's price moves for every point of movement in the underlying asset. So delta is a measure of how movement in the underlying market will impact the price of your option, otherwise known as the directional risk. Basically, delta tells you how likely the option is to expire with any value. So delta is often used in hedging strategies and is also referred to as the hedge ratio. So delta values can either be positive or negative. Delta for a call option always ranges from 0 to 1 because as the underlying asset increases in price, the call options also increase in price. Put option deltas always range from -1 to 0 because as the underlying security increases, the value of the put option decreases. So in the money call options get closer to 1 as their expiry approaches. At the money call options typically have a delta of 0.5, and the delta of out the money call options approaches 0 as the expiry nears. So the deeper in the money to call option, the closer the delta will be to 1, and the more the option will behave like the underlying asset. So Vega, so the second one, Vega, how much an option's price moves when the volatility of the underlying asset changes. So Vega represents the amount that an option contract's price changes in reaction to a 1% change in the implied volatility of the underlying assets. So Vega changes when there are large price movements, which is from the increased volatility in the underlying assets, and falls as the option approaches expiry. So when you own options, you have a positive Vega, whereas writing options or selling options carries a negative Vega. And then we've got theta, so how much an option's price declines over time, also referred to as an option's time decay. So an option generally loses value as time moves closer to the maturity of the option. Theta is a negative number and can be thought of as the amount by which an option's value would decline every day. So an option with high theta, usually one for short-term expiry, will rapidly depreciate in value as it nears expiry. We went through the lesson summary, and now we're on to simple strategy 1, trading delta. So simple strategy 1, trading delta. Date is a second. So simple strategy 1, trading delta. You aren't limited to trading a single option at a time. This means our options open up the possibility of many types of trading strategy using a combination of calls and puts. So you aren't limited to trading only one option at a time. These are known as spreads, and they involve both buying and selling options simultaneously. So spreads involve buying and selling options simultaneously. Spreads can help you make money even when a market is static. One of the most popular spread strategies is trading delta or delta spread. So delta spread is a spread strategy. As we saw in the last lesson, delta is a ratio that tells you how much an option's price moves for every point of movement in the underlying assets. Delta is a measure of how movement in the underlying market will impact the price of the option. So delta is a measure of how movement in the underlying market will impact the price of your option. So delta spread. Using a delta spread can be profitable when the markets are showing little or no volatility and you don't expect the price of an asset to change. So delta spread can be used when markets are showing little or no volatility and you don't expect the price of an asset to change, and you don't expect the price of an asset to change. You may be able to set up a delta spread to make a small profit if the underlying asset does not change widely in price. You may be able to set up a delta spread to make a small profit if the underlying asset does not change in price. However, larger gains or significant losses are possible if the asset does the unexpected and moves significantly in either direction. You can set up a delta spread to make small profit if the underlying asset does not change widely in price. However, larger gains or losses are possible if the underlying asset does the unexpected and moves significantly in either direction. With delta spread, you establish a delta neutral position by simultaneously buying and selling options in proportion to the neutral ratio. With delta spread, you establish a delta neutral position by simultaneously buying and selling options in proportion to the neutral ratio. In other words, the positive and negative deltas offset each other, so the overall delta of the asset in question totals 0. Deltas offset each other. Delta spreads establish a delta neutral position by simultaneously buying and selling options in proportion to the neutral ratio. Not ration, ratio. In other words, the positive and negative deltas offset each other. So the positive and negative deltas offset each other, so that the overall delta of the asset in question totals 0. That's right. The positive and negative deltas offset each other. So that the overall delta of the asset in question equals 0. The most common delta spread is a calendar spread. This involves constructing a delta neutral position using options with different expiry dates. This involves constructing a delta using different expiry dates. So, most common delta spread is the calendar spread. Calendar spread involves constructing delta neutral position using options with different expiry dates. In the simplest example, you simultaneously sell near month call options and buy call options with a later expiry date in proportion to their neutral ratio. In the simplest example, you simultaneously sell near month call options and buy call options with a later expiry date in proportion to the neutral ratio. Since the position is delta neutral, there will be no significant gains or losses from small price moves in the underlying security. However, as the near month calls lose time value and expire, you should be able to sell the call option with a long expiry date to gain an overall profit. Basically, you simultaneously sell near month call options and buy call options with a later expiry in proportion to their neutral ratio. Wait, so let me read through this example first. It's May. You think the FTSE is heading into a period of stability. You sell one contract, £10 lot size of the June FTSE 6000 call options. That's 130. So 130. So you think the price is going to rise because that's what the call option are. So you think the price is going to rise. While at the same time buy one contract, £10 lot size of the July 6050 at call option at 155. At the time of writing, this would give you a delta neutral position. Why would that give you a delta neutral position? Your aim is that the June option will decay faster than the July one. As long as the FTSE stays fairly stagnant, you could then be able to make a profit by selling the July call as the June one expires. Oh no, you sell one contract of June, so you sell a contract. Selling a call contract. Selling a call contract. So selling a call option can generate profit when a long call, so buy an option will result in making a loss. So sell call option if you're bearish about the prospects of the underlying market, so you think it would fall, or if you thought the price is likely to stay the same. Oh no, you're bearish, so likely to fall or think it's going to stay the same. So sell it thinking it's likely to fall or stay the same. Whilst at the same time buy one contract at 155. So time writing to give a delta neutral position. So you got a selling contract and you got a buying contract. Your aim is that the June, which is your selling contract, will decay faster than the July one. As long as the FTSE stays fairly stagnant, you should then be able to make a profit by selling the July call as the June one expires. I still don't get what it's trying to say, to be honest. So you sell a call option, so you're bearish about the prospects of it. So it's hoping it's either going to stay the same or fall. Decay faster than the July one. So as it gets closer to the expiry date, it decays faster, right? But wouldn't it decay faster anyway because the date for the June one is closer than the July one? So by selling July call, yeah, I don't really understand this, to be honest. But if it's going to stay stagnant, how is the buying the call option going to make you a profit? By selling the July call. Yeah, how would you make a profit by selling the call option? I know there was something about what is it? So you could sell it earlier before the actual option expiry date before the actual option expiry date has come, and you can still make a profit on it apparently. So where is it? Options, time of the expiry. Underlying price, no options of intrinsic value. Passage of time is good if you shorted have sold a written option. When selling options, so complicated market, time decay, buying call option, yeah, if the underlying market has moved sufficiently, your option could be worth more than you paid for it, even if it hasn't gone to your strike. You could close early, take a profit. So, but it wouldn't have moved sufficiently though, because you're hoping that it's not gonna move too much, because stagnant, right? Stagnant, yeah. So how would it move sufficiently if it's stagnant? Yeah, I don't really know, to be honest. I'll just write down what I can for now, and then maybe I'll understand later, maybe. So basically, simultaneously sell in a neutral ratio. That's that. Since the position is delta neutral, whoops. Since the position is delta neutral, there will be no significant gains or losses from the small price movements in the underlying asset. However, as the near month calls lose time value and expire, you should be able to sell the call option of the longer expiry dates to gain overall profits. Where's the premium? Have they factor in the premium? Or as the near month calls lose time value and expire, you should be able to sell the call option with longer expiry dates to gain an overall profit. The example, so yeah, I got no idea what this example means. What is a risk? With a delta spread, the maximum loss is approximately limited to the premium paid, but it can increase if the underlying has a large move and the delta of the option changes. The maximum loss with a delta spread is the premium paid, but it can increase if the underlying asset has a large move and the delta of the option changes. Should you be trading delta? So is the time right for trading delta? Ask yourself, is the asset price static? Does it look as though it could remain so for the period you want to speculate on? If the answer is yes, it might be time to look at delta strategy. To trade delta strategy, ask yourself, is the asset price static? Does the I still spelled it wrong after I came. Okay, static. Does the asset price look like as though it would remain static for the period you want to speculate on? If yes, can trade delta. So let's a summary then. Options provide opportunities for trading strategies such as using spreads, a combination of calls and puts. These can help you make money even when the market is static. One of the most popular strategies is trading delta or delta spreads. Delta is a measure of how movement in the underlying market will impact the price of your option, otherwise known as directional risk. Using a delta spread, you could expect to make a profit if the underlying security does not change widely in price. And remember, with delta spreads, large gains or losses are possible if the underlying asset moves significantly either up or down. Yep, nice. Simple strategy 2, straddle and strangle. Interesting name. Simple strategy 2. Simple strategy 2. Straddle and strangle. So straddles and strangles are slightly more complicated strategies than trading delta, but still among ways to start using the potential of options trading. Like most other options strategies, both straddles and strangles use a combination of calls and puts. Are they two different options then? Both straddles and strangles uses a combination of calls and put options. While delta spreads let you take advantage of static markets, buying a straddle or a strangle allows you to maximize your profit when the market is volatile. So buying a straddle or strangle, so use a straddle or strangle in a volatile market. The more volatile it is and the more the market moves in one direction, the greater your profits can be. So how to use a straddle. A straddle involves simultaneously buying both a put and a call option on the same market with the same strike price and expiry. By doing this, you can profit from volatility regardless of whether the underlying market moves up or down, but there is a risk. If no volatility occurs, you lose your premium. Straddle involves simultaneously buying both a put and call option on the same market with the same strike price and expiry. By doing this, you can profit from volatility regardless of whether the market moves up or down. You can profit from volatility regardless of the direction. However, if no volatility occurs, you'll lose your premium. A straddle purchases puts and calls with the same strike price and time periods. For example, let's say you expect a large move from Wall Street, but you're not sure which way it will go. June Wall Street contract is currently trading at 25000, 25,000. Set up a straddle, you buy both the June 25000 put and the June 2500 call. If the cost to buy each of these is 1000 points, your total cost is 2000 points times your stake size. If the June Wall Street contract stays where it is, you lose the premium. If it drops to 20000, the call will expire worthless. The call option will expire worthless, but the put will make enough money to move to more than cover the cost of the entire position. Premiums paid for taking out both options. If the value of the June Wall Street contract rises to 2800, you can use the call option. The put will be worthless, but the call should provide a profit. What if it only rises to like 26000? Would that be enough to cover? That wouldn't be enough to cover because your premium is 2000 points, so If it only moves up by 1,000, then yeah, it won't be enough to cover it. So, and then if not enough, if that's not enough to cover both, then you'll lose both your premiums. So yeah, both your premiums is at stake. Long straddle, break-even point, strike price. Yeah, so that's a long straddle, right? Whoops. What about a short straddle? With a short straddle, you can benefit if volatility collapses by selling both and calls and puts. Let's call it long straddle. Short straddle involves simultaneously selling both a put and call option on the same market with the same strike price and expiry. You can benefit if the volatility collapses. The strategy behind the short straddle is reaching a break-even point where the underlying asset is either at the money strike price or out of the money. This could be below the strike price for a call option but above the strike price for a put option. In either case, the option contract will expire worthless. The gain for you will be the profit you collected from the option premium. But the losses are like unlimited, right? Because selling options is like risky. The risk in a short straddle strategy is unlimited, yet as the underlying asset price could move up or down well beyond the strike price of either direction. Your maximum profit will be from the collected premium. And it will only be one collected premium, wouldn't it? Because the other option is going to expire worthless, so only one collected premium. So the risk in a short straddle is unlimited as the underlying asset price can move up or down well beyond the strike price of either option. I just realised there's words underneath here. The x-axis horizontal represents the price level of the underlying market, so this. I'm assuming that increases in price. Yeah, underlying market price higher, lower. The y-axis vertical represents the profit and loss above and below the x-axis intersection respectively. Profit loss. Strike price. This is the premium break-even point here. Profit. If it's below, if the price is below the break-even point, loss. Short straddle is the opposite, the mirror image of the long straddle. Okay, so should you be using a straddle? So is the time right for a straddle? Ask yourself, is the market static? Does it look like as though it would remain so? If the answer is no, it might be time to look at a long straddle. Do you believe that volatility will collapse? In that case, it might be time to consider short straddle. Ask yourself, is the market static? Static. Does it look as though it could remain so? If the answer is no, can try long straddle. Do you believe the volatility will collapse? If yes, if the answer is yes, can try short straddle. Strangle. A strangle is a similar strategy, but here you buy or call with a slightly higher strike price than the puts. So strangle involves buying a call option with a slightly higher strike price than the put option. This means that you need a larger price move to profit, but you will typically pay less to open the trade because both options are purchased when out of the money. What? This means that you need a larger price move to profit, but you will typically pay less to open the trade because both options are purchased when out of the money. So when you're making, we're going to make a loss. Buy a call with a slightly higher strike price than the puts. A strangle's key difference from a straddle is therefore in providing greater flexibility of balancing the cost of opening a strangle versus the profitability of a trade. So given the same underlying security, strangle positions can be constructed with low cost and low probability of profit, or higher cost and the higher possibility of profit. A strangle purchase involves puts and calls that are separated by at least one strike price in the same time period. Purchase involves puts and calls options that are separated by at least one strike price in the same time period. It involves buying a call option with a strike price that is slightly out of the money plus a put option with a strike price that is slightly out of the money. Involves buying a call option with a strike price that is slightly out of the money plus a put option with a strike price that is also slightly out of the money. So long strangle involves buying a call option with a strike price that is slightly out of the money plus a put option with a strike price that is slightly out of the money. Buy an option with a strike price that is slightly out of the money plus a put option with a strike price that is slightly out of the money. So basically, put a put and a call option that are both slightly out of the money. Okay. Long or short. Strangles can be either short or long. In the long strangle, you buy the calls and puts. The strategy is to profit if the underlying asset makes a move in either direction. Long strangle profits if the underlying asset makes a move in either direction. Use a long strangle. Okay, so use a long strangle if you're expecting the underlying security to make a significant price move, such as in advance of an earnings announcement. So use long strangles if you're expecting the underlying asset to make significant price moves, such as in advance of an earnings contract announcement. Your profit potential is virtually unlimited and your risk is limited to the option price you pay. The maximum profit is theoretically unlimited and the risk is the option price you pay. Premium, basically. So for example, suppose you see that the FTSE 100 has been in a tight range for a few weeks and believe it's due to break out of this pattern. The index is currently trading at 6500. You think that there will be a large move over the next few months, so you decide to buy a 3-month 6700 call priced at 25 and 3-month 6300 put priced at 30. You buy one contract, £10 lot size of each. Total cost of this is £250 plus £300, which is £550. This is your maximum risk. So expecting it to rise, right? Buy a 3-month call price. In 3 months' time, the FTSE has surged off of positive economic data, reaching 6800. At this point, the 6300 put is worthless, but the 6700 call is worth 100. You therefore realise the profit of £450 on this strategy. This is equal to the profit made on the 6700 call minus the loss on the 6300 put. So profit equals price of the underlying 6800 minus 6700, which is the strike price of the long call, minus net premium paid 55, which is 450. How is net premium paid 55? Is a net premium paid 550? Even though you have to let the put option expire worthless, you still have to count the cost of the option premium when calculating your profit. Yeah. Not gonna lie, I have no idea what this is about. I don't really understand what he's trying to say, to be honest. Like 30. Yeah, how is the net? Why is it minus 55? Shouldn't it be minus £550? Oh, I don't know. Maybe I'm tripping. Yeah, okay. I think I'm going to leave this episode here, actually. So hopefully in the next video my mind will be clear again and I'll have some chance to figure out what everything means. So yeah, that's it really. So yeah, I don't really. Yeah, I'm going to leave this episode here then. So thank you all guys for watching, and I shall see you all in the next video. Hopefully I'll have a clearer mind in the next video to figure this out. So see you guys later. Bye bye.